I wouldn't be surprised if a couple other banks show that they're on the verge of being insolvent. But Contagion doesn't look for one or two more to be insolvent. It's looking for a string of them, 5, 20, 15, a lot of banks becoming insolvent. And that would send shockwaves throughout the entire financial industry. The Fed would have to really use some emergency measures, and it would not be a good scenario for businesses as a whole. And we would see stocks continue to trade under pressure.
Big moves are happening today on Tuesday, one day ahead of the FOMC announcement on Wednesday, as the S&P 500 drops by 1.2%. The Nasdaq is down 1.1%. Gold is up 1.7% on the day. And so the question on investors' minds is what's going to happen with markets tomorrow after the Fed announces their rate hike or rate pause decision, if that is the case, at 2 p.m. Eastern on Wednesday tomorrow. Gary Wagner, editor of thegoldforecast.com, is here to break down market moves and give us his prediction. But before we continue, write in the comments down what you think the Fed's going to do on Wednesday and how the markets will respond. Gary, welcome back to my show, The David Lynn Report. Always good to see you.
Thanks so much for having me. It's great to be here.
The dollar is actually taking a bit of a slide today as well. We have to talk about the First Republic Bank incident. So over the weekend, First Republic Bank was taken over by the government, which then later sold its assets to J.P. Morgan. And like you were telling me offline, perhaps this has changed the way markets perceived Fed action. Tell us about the impacts of First Republic Bank sell-off on not just markets, but also the Federal Reserve.
Okay. Well, first of all, the insolvency by the Republic Bank and then the subsequent purchase of assets by Chase took the former stocks of Republic Bank, made them basically worthless. The exchange delisted that stock just recently, I believe today. And the fear is that there is more banks out there. In other words, the fear of contagion has reemerged, that there are many more banks that are not properly funded, that are making bad loans, are doing the things that would make a bank get in trouble. And that has spread across the financial markets as a whole, which is why we're seeing all of the indices, the major indices, the S&P, the Nasdaq, the Dow, trade lower today. Now, the dollar is lower. It's down about 27 points, but that's nothing compared to the gains in gold. Gold is up phenomenally and has broken out of that narrow band that has been so prevalent over the last 2 weeks.
We're going to talk about gold in just a bit, and I want to get your not just your outlook for gold for tomorrow, but also the rest of the month and the year. But first, let's talk about the probability of rate hikes. So pretty much baked in the cake for tomorrow, a 25 basis point rate hike. I'm looking at the CME Fed Watch tool. This hasn't really changed considerably over the last week and a half. However, you were telling me offline what is interesting and what has changed recently is if you go to the June tab. So if you look at the probability of a hike by the June meeting, markets are now pricing in a 15% rate cut. So 84%
Absolutely.
chance of no rate hike and a 15% chance of a 25 basis point cut. Tell us about that.
Well, it's the first time I've seen that particular outcome priced into the CME Fed Watch tool. Even yesterday, there was nothing on the radar that gave it a 0% probability of a rate cut. That changed today. Although it's a very small probability, 15%, the fact that it's being listed is significant. They are basically saying that we will see a 0.25% rate hike announced tomorrow. And then on the next FOMC meeting in June, we will have one of two outcomes, most probably a pause. So that was a big question mark within the minds of traders. Would there be further rate hikes? Realize that if they do implement, as it is widely believed they will, a 0.25% rate hike, it is the 10th consecutive rate hike. In other words, since March 2022 up till tomorrow's conclusion of the FOMC meeting, they have raised rates at every single meeting. And so the thought that they would actually pause is significant, because while it's been kind of talked about and hinted, alluded to by the Federal Reserve, they haven't made a concrete announcement that this is the point we'll begin the pause. And the fact that there is a very small probability, but a probability nonetheless that they will actually cut rates is against the grain of everything that the Federal Reserve has said. Because up till even a week ago, Fed members were saying we need more rate hikes. They were saying whatever we get to, where we end up at, will maintain that level at an elevated pace throughout the end of 2023. This is the first instance that we're hearing about a rate cut before 2024.
So wait, so rate cuts typically, unless they're fully priced in, should be good for equities. Why are stocks down today?
Stocks are down today because of the fear of contagion with banks, because the banks control so much of industry. In other words, if credit becomes tighter, which could easily be an outcome of contagion with more banks failing, that hurts businesses expanding. So we have high levels of interest rates right now. When we compare it, let's say, to a couple of years ago when they were virtually zero, we're sitting at 5% in essence, 4.75 to 5%. They raise it tomorrow, it goes to 5 to 5.25%. It's always between those 2 points. So we have interest rates. In other words, there's a real cost to money. Now, if there's a real cost to money and it's difficult to obtain credit, that crunches the wheels of businesses expanding and going through the motions of accelerating their business plans as they want to. And that, I believe, is why we're seeing the stock markets come down heavily.
But once the markets, so let's suppose the 15% rate cut is priced in more fully towards June. Let's say it's 50%, where perhaps the Federal Reserve eventually does cut by June. Do you think then the markets will rebound on that news?
I think, well, first of all, I think that the market could rebound if, in fact, they do that, and in conjunction, no other banks go under. I think the big thing is going to be whether or not this is an isolated case between Republic and the SVB, those two banks that were announced earlier. And I believe that if we don't get news of other banks falling into that trap where they're also being shut down or being monitored by the FDIC and action is being taken against them, that's going to tighten up credit. So right now, it's going to be about the solvency of the U.S. banking system, because the solvency of the U.S. banking system is critical for businesses to do business on a normal basis.
Well, what do you think is going to happen with the banking sector? Do you think we'll get more like First Republic?
You know, there's talk about that. I'm not privileged to any inside information, nor do I know what the books of these banks say. But I would find it hard to believe that there aren't others out there. I don't believe that there's going to be a slew of them that surface. I wouldn't be surprised if a couple other banks show that they're on the verge of being insolvent. But contagion doesn't look for one or two more to be insolvent. It's looking for a string of them, 5, 20, 15, a lot of banks becoming insolvent. And that would send shockwaves throughout the entire financial industry. The Fed would have to really use some emergency measures, and it would not be a good scenario for businesses as a whole. And we would see stocks continue to trade under pressure.
The FDIC seized First Republic over the weekend, but these actions took place after the earnings release came out last week. You'll recall that the stock dropped 40% as soon as the earnings release was released, I believe last Tuesday, when it was revealed that in quarter one, their deposits shrank by 40.8%. And so this was not something that happened last week. This was a reaction to a series of ongoing events that happened over the last quarter, mostly last month. And so the regulators, do you think that, no one knows for sure, but do you think that they reacted solely in response to the earnings release, or do you think that they already had knowledge about what was happening at First Republic, and they were just waiting for the release to come out before they otherwise they would shock the markets?
I think it was not only the release of the earnings, but how dramatically deposits declined. Deposits declined by a huge amount, and that's what sent red flags up. It was the fact that people were pulling money out of the banks and people were not putting money back into the bank. In other words, they didn't feel that was a secure place to put their money correctly, I believe, and therefore the earnings are going to go down. Absolutely. If you have less money coming in, you have less money that you can put out and loan out. And loaning money out is one of the primary sources of how a bank makes a profit. So if you don't have enough capital to loan out, your earnings have to go down. But I think it's the dramatic drop in deposits that kind of shook everybody up. As much as the earnings did, I think they focused on the lack of confidence in the bank by consumers, and the facts were that their depositors not only did not put money in, but they pulled dramatic amounts of money out.
JP Morgan Chief Executive Jamie Dimon said in a call with journalists on Monday that this is getting near the end of it, and hopefully this helps stabilize everything. He said that the American banking system is extraordinarily sound. That's his opinion. Well, let me ask you, Gary, you're based in the U.S. Do you feel safe with your money in the bank?
You know what? I do, but I'm not a company with millions of dollars that are running through the bank. And the bank that I put my money is actually based out of France. First Hawaiian is owned by a French corporation, so I'm not a good example. But I think that not so much that this is an isolated case. I think that you might find other banks that fall to this same kind of scenario. But I don't think it's dominoes falling. I don't think it's the beginning of the end. I think it's more the beginning, not beginning of the end, but it's more a isolated case that might spread to a couple other banks, but it won't be it won't be contagion. It won't be 20% of the banks are insolvent. I don't think we're going to see something like that.
What's going to happen tomorrow then? Fed announcement comes out at 2 p.m. Eastern time. First of all, do you think they'll raise by 25 basis points? Do you agree with the 85% probability on the CME Fed Watch tool right now?
Well, that's what not only does the CME Fed Watch tool, and those probabilities are built upon futures traders placing bets. They're putting their money on those probabilities. So I believe that it is extremely likely that they will announce a rate hike. They won't take a rate pause. They certainly won't raise rates more than 0.25%. I think that is completely off the table. And I think pausing tomorrow would be off the table. So I almost feel it's a certainty that they will announce a 0.25% rate hike. It's what they say about the upcoming and following FOMC meetings that people are going to focus intently on. Whether they make mention to, we might implement a pause because we see inflation ticking down. The problem with inflation and the strategy of the Federal Reserve is by intrinsically raising interest rates, you contract the economy. Contracting the economy sets off all kinds of problems. And the problematic scenario we have in the United States is a GDP that's growing as slow as a snail, so to speak. I mean, the GDP numbers that came in, although they were different than expected, they were still extremely low. I think that what people are going to want to hear is, are they going to announce that they will probably pause at the next FOMC meeting? Will they allude to the potential of a rate cut? Because if they do that, it's going to have a tremendous impact on the markets across the board. Of course, it would be extremely bullish for gold. In terms of the equity and financial markets, it should be bullish in a normal circumstance, unless the belief is that they're cutting to kind of cauterize the wound. And the wound I'm talking about is the banking crisis. In other words, if they have knowledge of many more banks that are going to go insolvent over the next upcoming weeks or months, then that would be seen as a fail-safe system to stop or cauterize that wound by making credit more readily available and making it less expensive than it was before.
Okay. And why is it that you said that you think a rate pause tomorrow is off the table?
Because I think that so many members of the Federal Reserve, right up until the blackout, came out stating that they believe that they need to continue to ratchet rates higher. And the reason they believe that is we have seen inflation in the US go down tremendously. At its top, it was 9.5%. It's now down in the fives, the cores in the fours. But 4% inflation or 5% inflation is still elevated. It's extremely elevated. And what concerns me is not the core, but inflation that includes energy costs and food costs. Because I think that most consumers know when they go in to get their staples and buy their food, that continues to rise. I mean, that's been up, I believe, 22% in some areas, and some segments of food have gone up dramatically more than just the core levels of inflation. And that elevated level has really affected the middle class Americans in that it's hard for them to make ends meet. And that brings a whole series of problems. Now, on top of that, we're going to have within a month, because yesterday, Janet Yellen wrote a letter to all of the leaders, bipartisan leaders, stating that the X date, the date in which the government will no longer be able to meet its obligations, could come as early as June and as early as June 1st. That's just a month away. And so you've got a tremendous divide between what the Republicans want to pass in terms of legislation. They passed a bill last week that would, in essence, strip out $4.5 trillion worth of government, not subsidies, but government programs. And they would add 1.5 trillion to the debt ceiling. And the Democrats are adversely against that, saying you have to separate the two. We have to add and raise the debt ceiling, but not throw any more programs in or take programs out. Those should be two separate issues. And that divide is extremely wide. And I think that in former instances in which we hit the debt ceiling and we had time until legislation was passed to raise the debt ceiling, we had a game of kick the can down the road. And as I stated in my letter yesterday, I think that kick the can has changed to where they're playing chicken. In other words, with very little time, who's going to blink first? And the problem is both sides are very dug in to their belief in what should happen. The Democrats, along with the president, are adamant about raising the debt limit by itself, not including other things and other programs and taking away and cutting. And what the Republican bill wants to do is really address $4.5 trillion worth of programs and do away with them. And so that's a large divide. There's going to have to be a tremendous amount of compromise on both parts. And the question is, there's very little time to do it. Can they accomplish it in time?
Janet Yellen used some very strong language yesterday. She said that after reviewing federal tax receipts, our best estimate is that we will be able to continue to satisfy all of the government's obligations by early June, and potentially as early as June 1st. She said that it's impossible to predict with certainty the exact date when Treasury will be unable to pay the government's bills. Sensational, very strong language. However, this is not the first time she's made similar statements. Back in 2021, she issued a very similar letter to Congress from the Treasury, stating that should Congress not raise the debt ceiling back then, a similar problem would occur. Is this, and of course, every time they do raise the debt limit. So my question is, Gary, is this a significant market-moving event such that we should even be worried about it?
Well, I think there's a difference between the tone and what she said was similar to what she said in 2021, but there's a key difference. January 19th, we hit the ceiling. The government officially was out of the ability to pay their obligations. Now, What Yellen did is she presented extraordinary measures, those were her words, in which pension fund money from many government officials that would normally have been invested into the stock market for these pensions years down the road are being sidelined, and she's using them to pay bills. And so right now we're in a scenario where one, the debt ceiling has been reached. So she can't spend any more money because it isn't there. And she's now taking away from Peter to pay Paul. In other words, she's taking pension money. If you recall, when Trump ran into the issue, he stopped paying the national services like the park rangers and other things that he called non-essential services. So Yellen is really getting backed against the wall if they don't do anything. But your point is excellent. They always seem to come to a decision and an agreement. And in the history of the United States, they've always met their obligations. So what makes me think that this is different? I don't. I think that it's going to be a hard-fought battle. I believe it will be an 11th hour fight, so to speak. And in the end, both sides know that to do anything but raise the debt limit ceiling would cause unbelievable damage that will never get undone. And one thing that Yellen said, not in this letter, but in a letter or a speech prior to this, was the repercussions of us not raising the ceiling will go on in forever. And that was an interesting statement. She was trying to really underscore the dramaticness that this has to get done. So do I think that they'll not do it? No, they've always done it in the past, but typically it was kick the can down the road. They had time to solve the issue. Now they don't have nearly as much time, and the divide is great, and that's my concern.
And so bottom line then, what do you think is going to happen with stock markets and gold tomorrow following the FOMC press release?
Well, I think that, gold had a tremendous rise, up $33. It's broken above former resistance levels. My charts tell me that if it continues to go, I'm looking at $2,043 as the next level of resistance. Above that is $2,063. I think that for the most part, today's move was fully baking in the idea that they would raise rates by only a quarter basis points. I think that if the talk tomorrow by the Fed is they might institute a rate cut, we would see the metals move much higher. If they talk about a pause, I think that that's been pretty much baked into it. We should see it rise, but not the type of dramatic rise that we saw today.
Oh, we're going to come back to gold, but and for the stock markets, do you think that, I know you like to think of it as a basket of stocks, but just overall the index, do you think that's going to...
I think what the stock markets are looking at more than anything else is not whether or not the Fed raises rates by 0.25%. I think what they're looking at, are there other banks out there? Is this the beginning of a domino effect in which we see multiple banks fail? And if that happens, how will that affect credit? Will that tighten to a degree that their programs where they're going to be seeking funds to do whatever their plans are to advance their companies, if that's not going to be available? And if they can't grow their company, equities will suffer from it. And so they're going to focus more on the banks than on what the Fed says, U.S. equities. Gold's going to focus more on interest rates.
Now let's talk about gold. Like you mentioned, we've had a significant run up to $2,000. Let's talk about that run up first and then what's next. So what were some of the key drivers of this run up in gold that we've seen? Certainly it wasn't higher inflation because inflation came down on paper.
Right. Well, the beginning of the move, in other words, moving a couple of weeks ago above $2,000 per ounce, had to do with the first knowledge that there was insolvency in two banks, and the fact that that could lead to a contagion scenario in which more banks fell. They reacted when that news officially hit. However, over the next couple of weeks, no new news came out in which they felt, you know what, this is going to spread. And so the anxiety kind of dropped a lot because the belief was this is really an isolated event. and it's not going to spread to a lot of banks. So we don't really have to worry that much. And then when we saw the insolvency of the Republic Bank and the fact that the stocks were delisted and that Chase actually bought, JP Morgan Chase bought all of the assets, they realized the reality of the fact that this bank is gone. And does that mean that more banks will follow? And so today we saw gold rise really for the same reasons it initially rose above 2000, and that's concerns about an elevated banking crisis.
Well, gold breached $2,000 in early April, so it's been chopping around in a band for a number of weeks. It's been coming down since its high in mid-April, and then just yesterday and today, like you mentioned, it's spiked up back above $2,000. What is it about this $2,000 level that is so significant? Because we haven't seen a sustained move above 2,000.
Well, for the last 2 weeks, we've seen it oscillate above and below. The last week was mostly below, but genuinely very closely below. In other words, it would close at 97, 98, 95. The week before that, you had it oscillating where it would close 2003, 2007, sometimes at 98, but it oscillated back and forth. If you look at a candlestick chart, you had red and green candles, meaning the open was lower and the open was higher. It was absolutely consolidating, waiting for more news. Today was a solid breakout on a closing basis. In other words, we've seen over the last 2 weeks, gold go as high as maybe 20, 25. On a candlestick, we call that the wick. That's the differential between where it closes or opens, the real body of the candle, and the high of the candle. So we saw many moments where it would wick above certain points and go higher than 2020, maybe as high as 2025. We also saw multiple occasions in which they took prices down to $1,980. There were 3 attempts in which it went to that price point, and each time it recovered before the closing price or before settlement and the market closed that day. So we've seen it have this $50 range, really $40 range, and it hasn't been able to break below 1980 or above, say 2020 on a closing basis at all. Today was different. Today we've got settlement at $2,026. And so if we see it stay above there and even maintain that, maybe challenge 230, but close above 220, that's a new ball game because we haven't seen that in gold. Remember, when gold rose, it rose to those tops. It stayed there for a while. The top I'm talking about is 2,065, but within a week it dropped. It dropped dramatically down to first above 2,000 and then below 2,000, and then it started to oscillate up and down in between it. So 2,000, your question initially was the importance of it. To retail investors, it's a huge psychological level. But to hedge fund traders, algo traders, money market managers, 2,000 is irrelevant. They don't look at that number with the same importance as the retail investor does. And so they're looking at the fact that it's been holding a certain area and it has a high likelihood to climb. I think that we could see gold challenge 2,043. That's the next technical level of resistance. Above that, of course, is 2,063. That's the recent high. And then just above that is the all-time record high, which is 2,088. But on a closing basis, the day that it hit 2,088, it closed at 2,069. So that area right below 2,070 is a critical number. If that number gets taken out, we're easily going to see it challenge 2,100.
What needs to happen for gold to break new all-time highs? Weakening dollar? More banks collapsing?
Well, first of all, a rate cut by the Fed at the next FOMC meeting would be extremely bullish because what has hurt a gold price has been rising interest rates. If inflation remains steady, because inflation drives gold higher, interest rate drives gold lower. And so when you get cuts in interest rates and inflation remaining elevated, it is the perfect recipe for higher gold.
let me ask you this: have retail investors and regular people started buying more gold and putting their money in physical gold bars in vaults, and taking money out of the bank? Have you noticed that happening at all?
The belief is that there's been a tremendous interest in investors accumulating gold and silver, but gold for the most part as a safe haven asset. The other thing is that if you don't have a fervent belief that your money's safe in a bank, the question you ask me is, your money safe? Where else are you going to put them? And one place is the safe haven asset of gold. Over time, that's always offered some stability. So when you have a combination of the potential of more bank failures, and I'm not saying that there will be many, I don't know, but the potential of that and the fact that they're doing interest rate cuts is something that would be highly supportive of higher gold prices.
Do you think that the rising gold price to $2,000 that we've discussed, was that purely a reaction to bank failures, or do you think the gold market is perhaps predicting a recession or further economic downturns independent of banks?
That's obviously something I believe that is within that mix. Absolutely. Within the fabric of why gold has been moving higher, that's one of the essential threads there. The other thing is people are concerned about the fact that the United States has once again hit a debt ceiling, and we're getting closer to the point in which a decision has to be made, and nothing has happened yet. So that creates a tremendous amount of uncertainty. All of these things point to less stability, less trust in the government entities and their ability to keep things on track and keep people's investment dollars safe.
Okay, so bottom line, would you buy gold now or accumulate more at current levels, or would you wait for more of a pullback first?
I would buy gold at every level. Personally, right now, I believe that you should have been accumulating and you should continue to accumulate. As you know, at the end of last year, when I was asked what I believe will be the price of gold at the end of 2023, I said about $2,200. And I stand by that. I believe that gold will be substantially higher by the end of this year, first and second quarter of 2024. That prediction has not changed. If anything, it's strengthened in terms of my conviction or belief that that will come into fruition.
All right. Well, I'll definitely get your updates as market moves further down the line. Thank you very much for your time today, Gary. And before we go, where can people follow your work?
Absolutely. Thank you. Thegoldforecast.com is our website. We have a 14-day free trial to our daily service. Our YouTube channel is The Gold Forecast, and we have all of our videos that we've ever done on that server site. And then at Gary S. Wagner is what I use for my Twitter handle.
All right. We'll put those links down in the description below: your website, YouTube, and Twitter. Thank you again, Gary. And thank you for watching the David Lynn Report. I'm David Lynn. Stay tuned for more, and don't forget to subscribe.